Right, welcome to the revision where we are dealing with application of management accounting techniques. Right, so this is the part where we deal with cost accounting. Right, this is the part where we deal with cost accounting, and it's very easy. Another easy part of this module. Right, so we are going to do so today by looking at the May-June 2017 paper, which was your choice, and we're going to start off on question 1, trying to look at the important things, trying to bring out the important things. So remember, if you don't remember anything today, just remember the concepts, just remember the concepts, just remember the principles, because that's what they are going to be checking. How are you applying these principles? That's what they are basically checking there. All right, so question number 1, let me just flip through to question number 1 so that we don't waste a lot of time. So you always want to go again, you always want to go to the required section and then see which question you think is easy for you to tackle. So number 1 is calculate the budgeted selling price per unit of BP tire for 2017 financial year based on CVP analysis report as presented by the CFO on the 1st of April 2016. And then briefly explain the difference between the break-even point and the margin of safety. Right, and then C is calculate the budgeted break-even sales units for 2017 year based on the CVP analysis report, that same report. So I'm assuming that all this that I'm doing now, you'll be doing soon after you get the question paper, 15 minutes before the start time. Then we have to ignore the implications of opening and closing inventory. We're on part C. Then part D, assume the actual selling price is 860 per unit throughout the 2017 financial year. Prepare the actual income statement for each of the 6 months period based on the absorption costing method. And then E, assuming the same price, 860, now we are using the direct costing method. And then F, we are reconciling those two. And then on the 25th of February, Minister of Finance announced the introduction of a new tax level of that. Briefly advise Inkunzi about the possible implications of the tire tax on its business. I don't know if I've seen Inkunzi somewhere on the study guide. I can't remember that, but the name really sounds familiar on the question bank. I don't know.
It's question 3.2.
On the question bank. So it's the same question.
Yeah, same.
Hey, man. I should have known. We're not even going to pick this one, because this one you can. So okay, that's why someone was asking me about something on the question bank, and I said, I was gonna get to them. Maybe it was maybe it was on this one here. All right, but it's fine. So you can just keep that on check. I think the question bank that I have is the one that I have here is the one for the year modules. Yeah, the one that I have is for the year modules. So I suppose this should be on 3701. All right.
Yes.
3701, right? Okay, that's fine. So let's say we start off with this one here. Right? Let's suppose now we start off with this one. So in terms of principle now, when they say calculate the budgeted selling price per unit of BP tire for 2017 financial year based on CVP analysis report, cost volume profit analysis report, these are the things that have got to do with break-even calculations, etc., contribution and what have you. So we are required to calculate the selling price based on those kind of things, right? That's the requirement on that there. All right. So let's see what we have now, what was on the report. Right. So now that we've read through the questions, then we can now start searching and seeing where we can find some of these, some of the things that are relevant to that. All right. So the company's financial year ends 31st of March. So it's divided into 2 periods. We've got period 1 and period 2. And then, so another important thing is to check in management accounting what costing methods they are using, right? It might not be that relevant in this one since we have to do both, but it's always good to check. Sometimes they just say prepare the absorption, or they just say prepare the income statement. Then you need to figure out whether it's absorption or direct costing. So you check that on this kind of information here. Right, and then the company's annual normal production is 6,000, and then production and sales occur evenly throughout the year or throughout each financial year. So why is this important? So the production capacity helps us when coming up with our overhead absorption rates. Right? They normally use on the normal production capacity. So the key word there is normal. Right? So which is what we expect year in, year out. So whenever they decide to what capacity they use or what level of activity to use in terms of absorbing the fixed costs, they normally want to go for the normal, right? So the normal sometimes could be below full capacity. It happens. So if that's the case, always go for the normal, right? So we've got our 6,000 units there, and then the company's tax cost of capital after tax cost of capital is 12.5% annum for both 2016 and 2017. All of Inkunzi's inventory are accounted for in first in, first out method, right? And then at the management team meeting held on the 1st of April 2016, Chantel Smith presented a budgeted cost volume profit analysis report for 2017 financial year, showing that Inkunzi should earn a budgeted net profit of 320,000 for the year 2017 financial year if the company produced and sold 5,000 units. Okay, so this is the report that we see now. So based on this now, okay, and then we've got the budgeted costs given there, 750, and what have you, that's given right there. All right, so based on this now, I think we can simply begin this question. Calculate the budgeted selling price per unit. So we need the budgeted selling price per unit. What are we given? Let's work with what we are given now. So this is the first clue that we have. Inkunzi should earn a total budgeted net profit of 320,000 for 2017 financial year if the company produced and sold 5,000 units. So the clue is CVP, right? That's the first clue. So these guys are basically giving us the answers, right? CVP, so we know that we need to apply our CVP knowledge here, cost volume profit analysis, one of those formulas there. And then which formula in particular, the one that should give us or that could enable us to earn a profit of 320,000 given that we are producing and selling 5,000 units. So the idea that I already have now is the one for target profit, right? It's that simple now, the one for target profit. So we know that. Let me just jot it down here. So we are on question A. So because this is a question paper where I can't copy this thing, I'm just going to type required A. Right. I'm just going to type required A. So does anyone remember the formula? Right, so this would be the part where you probably want to check on your question bank or whatsoever, because I'm not going to give you the exact words on that, but I know in that formula we want to get the units produced and sold, to give us a target profit, right? So that would be fixed costs, or its total fixed costs rather. There's an important difference there. I'm going to explain that difference. Total fixed costs, what do we add that to? So because this is similar, I remember doing this in class and I was mentioning that it's similar to your break even, except that you put your target profit there. So if you are doing break even, the target profit would be 0. So which is why you normally just have total fixed cost divided by what? By contribution per unit. Contribution per unit. So the answer that we need here is somewhere in the contribution per unit, because on the contribution per unit, that's where we get our sales minus our total variable cost. That's where we get, and we specifically want the sales. So we do that by first getting the contribution per unit, and then we can use that contribution per unit to get to our sales, right? Are we together so far? So if we are not together, please just show by unmuting yourself and saying something. There's something that somewhere where we are already missing each other. All right. So what do we need now? So it's total units produced and sold. So let's go and fetch that there. Let's go and fetch that information there. Right. Like I said, you want to stick to the actual weights in the formula, right? So you can always check out those actual weights anytime. So we are saying now, in order for these guys to earn a profit of 320,000, they need to produce and sell 5,000. So which means we can put that information there now. So which means over here, we want to have 5,000, right? Let's put that. It should come somewhere there. So 5,000 is going to be equal to total fixed cost, which we need to get, and then the target profit is going to be 320, right? So let's first fetch the total fixed cost there. So just give me a second. Let me just fix something here. All right, sorry about that. Okay, so the correct way of getting our fixed cost now, let's see. We want to check the number one, the financial period that we are dealing with, right? So we are dealing with 2017, right? Which was presented on the 1st of April 2016, but for the budgeted for 2017. So we want to fetch all that information. So in other words, we need the fixed costs for 2017, so which is going to be somewhere in this period there. All right, so let's see what goes on there. So the budgeted product cost for each BP tire for 2017 is 750 per unit. So something that's going on here, okay, we are going to add this here so that we just ensure that there's nothing amiss here, because sometimes the wording that they use here could be very confusing and misleading. But what we need so far is the fixed manufacturing overheads, and then we also need, for the selling and admin, we want the fixed portion for that. I believe those are the only those seem to be the only fixed costs that we have here, right? But if you have time, then you might want to add these and see if they actually add up to 750, but of which they most likely shouldn't really add up to 750, because if they say the product cost, selling and admin is not really a product cost. These ones are supposed to be period costs there. But just out of interest sake, but you don't really have to waste your time on that. It's not going to give you a lot of marks. You just need to hand pick the ones that you feel are useful here, right? So for the fixed manufacturing overhead, so we have got 300, right? We've got 300, and then I already read the statement here about, I think it was on top, right? About the normal capacity on number 4 here. Normal production capacity is 6,000, right? So we are going to make use of that 3,000, or sort of that 6,000. So maybe you might want to ask the question why I'm not using, say, the all right, no. Suppose there was anything else that was given other than 6,000. Suppose there was a budgeted production level of 5,000, and then we had a normal capacity of 6,000, right? So the big question would be, which one would you choose there between the budgeted 5,000 units and then budgeted 6,000. Sorry, and then the normal capacity of 6,000. So the correct one to use there, would be the 6,000. I don't care what your lecturer thinks about that, but the correct one is 6,000 because your fixed overheads, right, are fixed, right? The fixed overheads are fixed. And then this 300 here comes as a result of dividing the total fixed overheads by the normal capacity. Right? So at the end of the day, if your production varies, right, basically brings rise to, or gives rise to over absorption and under absorption and what have you. So it's got nothing to do with the total fixed overheads. It's got nothing to do with that. So what we need on that formula is total fixed overheads, not the absorbed overheads. So the absorbed are the ones that depend on your production, right? Your production is basically going to be varying. Sometimes you produce less, sometimes you produce more, for one or two reasons. So we can't use that to make decisions. So we want to have clear and, consistent amount. So which is why we use that particular one, which is the normal capacity. Right? So the normal capacity will give us the total fixed costs. Then if you use your budgeted production, that will give you your absorbed, right? It will give you your fixed costs that are absorbed in the production in that particular year. So you don't need that there. Right, so we are going to take 300. That's the one that we know so far, the fixed cost that we know. And then in terms of presentation, it would be nice to put it, let me present it nice, not like a mathematics student. Right. Fixed, let's say total fixed cost. The last time I had a job, my boss always used to say, you always have to present your work in such a way that it's understandable. Just that you are not the only one who understands it, but the next person is able to understand it. So that's what I'm also trying for us to do here. All right, so which is gonna be 300. So we are multiplying that 300 there by, okay, excuse me, it's didn't right. Multiplying that 300 there, we say its normal capacity is 6,000. So we want to multiply that there by 6,000. But these are not only, these are, okay, we have some more fixed overheads. So we need to add to that there. So in terms of the fixed overheads, we have selling and admin costs. So selling and admin costs are 60% fixed and then 40% variable. So which means here we basically apportion them in that ratio of 60% and 40%. So we want 60% there. So we can therefore put it in this way. So it's 11250, right? 112.5 times. So the one that we want is 60%. And then again, what capacity, because this is per unit, so we can deal with that because it's fixed, right? So if you remember well, the definition of a fixed cost, in theory, they don't change depending on your production, 6,000, 5,000, sometimes it's 7,000. Your fixed costs are gonna remain the same. So which is why we are using the normal capacity. All right, let's put down the answer there. So if you can calculate with me, this is gonna be 300 times 6,000 plus 112.5 times 0.6 times 6,000. So this is gonna be 2,205,000. So we take that and we put that there. 2,205, 1, 2, 3. And then what's the target for profit? Target profit is given as yes.
Is it 6% or 60%?
All right, I'm gonna check that now. I'm gonna
It's
check that.
60%.
60%. What did I write?
0.6.
Yeah, so it's fine.
Correct.
0.6%.
It's correct.
It's fine. But thanks for checking that. Please do do check what I'm doing here. Ne?
Okay.
All right. And then what was our target profit? Let's see what our target profit is there. All right. Our target profit is given as, I think we had it up to 320,000. Right, let's put that there. Okay, where are we here? So plus 320,000. Right. Maybe we might want to indicate that this is on calculation 1. Eh? This is on calculation number 1. So now maybe we should be smart about this, né? So that we don't waste time. Let's just say our contribution per unit is X. Right? Let's just say our contribution per unit there is X. So let's divide that by there by X. Right. Then we want to find X there. So this is that's there divided by X. And then yeah, let's see what we can do. So maybe we can add those two 5,000. Right, let's see. Let me just add it on the side here for us. 2205 123 plus 320 123. And so we get 2,525,000. Ne? So this is gonna be 2,525,000 divided by X. All right. Excuse me. All right. So if we multiply by X, here we would have, we are cross multiplying, multiplying both sides by X. So we would have 5,000 here by 5,000X, right, is equal to 2,525,123. And then we divide both sides by 5,000 so that we remain with X here. So we would have 2,525,123 divided by 5,000. Let's increase the space here. All right, so our X is going to be equal to, let me punch it on this little calculator here. 2,525 divided by 5,000. Right, I'm getting 505. I don't know if you're getting the same there. 505 for our contribution here. Are you guys getting the same? Right, please just repunch that and check for me. Let me punch it here.
Yes,
so
Dando.
getting the same name. All right, perfect. All right, back to the question. So what do we need? We need selling price, right? That's what we need. But now let's have a look and see what adjustments we need to make there so that we get the selling price. So if our contribution is given as that there, and then these are all the expenses that we have, then we can use that there to get our selling price. So let's put down the formula for contribution. So our contribution, which is what we have calculated here. No? So contribution per unit, right, is equal to selling price minus total variable cost per unit. Okay, makes sense so far. Ne? What do we have now? We have calculated this 505, so we can put this 505 here. Right, selling price is what we want. Right, so we know that if we deduct selling price from the total of our variable costs per unit, we can get our contribution. So one way in which we can present that is obviously in a format that's going down, in a format that they might just prefer, right? But You don't really have to do that if you want. Okay, so these are the costs that we want to put in. So we want to take, we're looking for the variable ones. Yeah? So we want to take direct raw materials, direct labor, variable manufacturing overheads, then we leave that out, and then selling and distribution, we only want 40% now. I believe those are all that we need there. Okay, let's put them down. So I'm just going to minimize the screen there so I can see them while I type. So this is going to be 150 plus 75 plus 112.5 plus, so this 112.5, the other one is the one where we only need, we say about 40%. So times 40%, and then we can close that bracket there. Okay, so now we can do the calculation. So this is going to be 505 is equal to, so this x is going to remain an x for now. Right. Let's see now how we can calculate that. So this is going to be 150 plus 75 plus 112.5 plus 112.5 times 0.4. So that gives us 382.5. 382.5. So we get that amount there. So we want to remain with x on one side, so we can take this 382 over the side there. So that would be 505 plus 382.5 is equal to x. Okay. Right, let's punch it here. 505 plus 382.5, that gives us 887.5. So x, we can as well write it this way. X, which is our selling price, is going to be equal to 887.50. Right. So in most cases, the most important thing that the markers are looking for here is going to be your application of this formula, right? Identification, obviously, for starters, that you've identified that simple formula that's applicable in this scenario, and then your substitution. Your substitution may not really matter much because you're only dealing with 1 or half a mark thereabout, right? And then sometimes you realize that you could have missed some fixed costs, right? You could have missed some fixed costs and what have you. So whenever you make a mistake here, don't worry, you just move on and let it go. Exam strategy is strategy that gets you to pass. So this question is how many marks? 10 marks. So if you have applied the principle like I did, and then maybe you've missed 1 or 2 things, you most likely get anywhere between 7 and 10, right? Because you've simply shown the markers that you understand this thing, you understand the principle, right? You understand what's going on there. So another way in which that could have been presented, of course, is to have it where in a way where you put your selling price there on top, and then your total variable cost, then you list them down one there, and then you use your selling price as your balancing figure, right? So you basically have your selling price on top, then total variable cost. You've got these listed in this manner, and then contribution at the bottom. Then you add those two to give you the selling price. That actually would have been a nicer way of presenting it, except that I can't copy from the question paper, so I don't want to waste time. But this is still acceptable. This is still acceptable. Right? There you get your mark. So which means in order for us to achieve a profit of 320,000, selling 5,000 units, our selling price should be 887.50, given these variable costs per unit, right? Given these variable costs per unit. All right, any questions on this? Any questions? Any questions? No questions. All right, we shall move on. Therefore, we shall move on from this. All right. On the next one now, briefly explain difference between break-even point and margin of safety. So when you get a question like this and you simply don't know the answer of this question, then just put down the formula and then you can put on even a stupid explanation, but you can still get 2 or 3 for the formula, right? At least-
Ubando, can I ask from
Yes.
the previous question, is it wrong if you take a profit? Because again, they're asking for the selling price per unit. So if you take a profit, like the one that is given, which is 320, and then you work it from there, and then you add the variable cost to get to the selling, will it be wrong if you use that method? I'm not so sure.
That would still be fine. I thought of that as well, but the problem that I would have on that one is that works, yeah, that works. Given that you can take your 5,000 units and then you multiply your 5,000 units by these amounts here. So that can still work out. So what you can do again, by the way, since I'm also going to be having my own version, and then you can also try it, that other version. You should still get the same answer. But why I specifically went for this one is because I was impressed with CVP. I was impressed with CVP. So, which is why I specifically went for this one. And I thought it would be easier for me to work this one out quickly this way. But which means your way, you start off with your profit, then you have your profit, and then you add back your fixed costs there, right? Your fixed costs, these ones are given in total, and then you also want to add back your variable cost.
Variable cost.
You still get the same answer. Did you try it that way?
Yes, I did.
What was your answer?
I didn't get the same. Mine is 874, but I still need to check mine. It's okay. I'll go back.
Just check it out and see, and then let me know. All right. Then on question, okay, so on this one here, on part B, explain the difference between break-even point and margin of safety. The difference between break-even point and margin of safety. So if you don't know this one, which is most likely, right? Because I also can't remember how to explain it. But our starting point can be the formulas, right? So break-even point, you can put it up there. It's gonna be your fixed cost divided by your contribution per unit. While your margin of safety is gonna be your sales units minus your break-even point divided by your sales units, right? Then you've got a good starting point there. Then what is break-even? Break-even is basically the amount of units that are required to sell for you to neither make a profit nor loss, right? Then your margin of safety is the extent. It basically describes the extent by which your sales exceed your break-even point. That's what basically is. So with your margin of safety, you realize that it becomes bigger when your break-even point is less. You basically get a bigger margin of safety. So that can pretty much give you 4 marks on that one. Right, and then calculate the budgeted break-even sales units for 2017. The budgeted, calculate the budgeted break-even sales units for 2017 financial year based on CVP analysis report as presented by CFO on the April 2016. So this is where you might want to make use of the amounts that you got there. Né? So it's another 10 marks. So obviously, with the formula that we've given, it's gonna be your fixed cost divided by, what are we dividing that by? We are gonna be dividing that by contribution per unit, of which our calculation already gave us contribution per unit there, so you can simply bring that over on the next question there. Right, so let's jump to required number C. So we want break even units. We want break even units. So on that break even units is gonna be equal to total fixed costs, right, divided by contribution per unit. Right, contribution per unit. Right, since it's based on the same calculation, we shouldn't have a change in total fixed costs there. We shouldn't have a change in the total fixed cost. So this is where you can try to refer to calculation 1 divided by what is our contribution? Our contribution is 505 there. This is what we call cheating a question. This is what we have done here. So 2525,123 divided by 505. Then we get our 5,000 units. Oh, sorry, no. Sorry about that. Not this here. We had included target profit. Sorry, so it's not 252. We need just the fixed cost. So the fixed costs are 2205. My bad. The fixed costs are. I'm wondering now why we are getting the same unit as for that target profit. So 205,000. So these ones here are coming from total fixed cost there. So 2205. All right. Let's divide 2205, 123 divided by 545. So that should give us 4367. That should give us 4367. Right. So we'll have cut many corners here. We'll have cut many corners. Number one, the first corner that we'll have cut here is the total fixed cost. Right, the total fixed cost, which we have already calculated from that formula. So one of the reasons why I specifically went for this particular one here is because of how closely related it is with part C. So we won't have to do a lot of work again, coming to calculate for starters contribution per unit, pulling up the variable costs again. So that would basically not work, you see. So it will work against us in terms of time. Right? That will basically work against us in terms of time. So ideally, your contribution is going to be, if there are no further assumptions that are made, right? Because the one other thing that we need to be looking out for is for further assumptions that are being made. Right? So if there are no further assumptions, for instance, assumptions on the, right, if there are going to be assumptions on the selling price per unit, for instance, if they've given us that, let the selling price be such an amount, then we stick to the same selling price that we calculated there, right? And of which our calculation there pretty much gave us not just the selling price, but it started off by giving us what? Started off by giving us the contribution per unit, right? Which is what we got there as the contribution per unit. So instead of redoing this calculation here, you don't have to do that. So you always have to refer back to calculation A. So this is what we have on that there. Then in terms of break even, again, you always want to round up. Right? You always want to round up. You always want to go for 4367. You always want to go for the higher amount. Right? If you go for the lesser amount, it means you are not breaking even. Right? You are slightly making a loss. So it's better to make a slight profit than to make a loss. That's the logic behind that. All right. Then if you decided to use the other method on that one, the one that she mentioned, that you can start off with your profit and then you work up on that one. Then you come down here pull up your fixed costs, and then you calculate again your contribution per unit, then it's going to give you that amount there. So if there is nothing that we left out, then we will leave the question and jump to part D. I don't know if we have any questions so far. Any questions? No questions. All right. Part D, assume the actual selling price for each BB tire is 860 per unit throughout the 2017 financial year. Prepare the actual income statement for the 2 6-month period using the absorption costing method. So one is going to be period 1, and then the other is going to be period 2. So we'll work it like that. So if it's going to be 12 max for that one, we assume it's a 6-6 kind of thing. 6 for period 1 and then 6 for period 2. All right, let's see. So let's say actual income statement. All right. Right, this is where, let me share that part there. All right, sorry, let me just get a charger for this phone. All right, there we go. So we can have our period 1. I was running out of battery, sorry. So we can have our period 1. Let's put it where? Let's put it somewhere here. Period 1 and period 2. So that we can have enough space to put our calculation. So if we're using this is required part D. This is required D. Right, so if we're using the absorption, you already know the formula for that one. So it's going to be sales and then cost of sales. Right, so with the absorption, that's where we want to have gross profit. So which will make use of opening inventory. Right, and then we can have production costs, and then we can have closing inventory right there. All right, since we are dealing with the actual statement, then most likely we might have under or over recovery, but we'll get to that now. Under and over recovery, but we're going to get to that and see what's up on that one. All right, so assuming the price is 860 rands throughout the financial period, so we now have the selling price. We will now have the selling price. Right, we will now have the selling price on that one. Okay. So not only do we need the selling price, so this is the actual information, actual manufacturing and trading results. Right, so the number of units number of sales units is 2375 and 2375 for both periods. So you can put that in there. All right, let's first check what the selling price is again. It's 860, right? 860. All right, let's go. There we go. So which means this is gonna be 860 times 2375. So these are the same for both periods. So you can as well just leave it out as it is. Okay, let me try and drag this further down. All right. We don't want any commas. All right, so this is gonna be 860 times 2375. So this is what we get there. So these amounts are just the same. So we can keep it at that there. All right, now we need to calculate the cost of sales. All right, cost of sales is going to require us to make use of opening inventory. So maybe we can start it off this way. So our opening inventory for period 1 is going to be 500 units. Right, so we can put up our 500 units there. Units, and then we're using the absorption method. So we want to multiply that 500 units times all the production costs. That's all the production costs, which is the variable and fixed, because we are using absorption costing. So that's what we want to fetch now from the scenario. So actual variable manufacturing costs for BB is 300 per unit, and then the fixed manufacturing overheads rate for the same period is 290, right? Is 290. Okay, so bear in mind that there is a difference usually in management accounting when they say variable manufacturing overheads and then variable manufacturing costs. So in this instance, when they say variable manufacturing costs, it basically includes even the costs that are not overheads, right? Which is your cost of materials, etc. They are included there. So in other words, all your direct costs are going to be included there. And when they overheads are overheads, right? They might not include, they will not include material, they will not include labor. So in this instance, which is for the 2016 period, right? For the 2016 period, so the company had no other inventories except for the ones that we here for the 2016 and the 2017 period. And then for the 26 period, these were the manufacturing costs for each unit. So it's going to be 300 for, which is the variable, and then for the fixed, it's going to be 290. So to get the total, then we are adding 300 and 290 there to give us the total costs, right, that we absorbed in the previous period. So it's going to be 590 multiplied by the number of units there, which is 500. So that's what we are doing there. So if you'd like to show that, then you can simply show it by, let's show it 290 plus, it's going to be 290 plus what? Plus 300, right? Then we have that this way. So I'm only doing the calculation now for the opening inventory in period 1, because when it comes to period 2, the opening inventory there is going to be closing inventory that we have calculated right there. So hence there is no need to show the working on that one. All right, so this is going to be 500 times, what is 290 plus 300? That's 590. So we multiply those two there. That's what that gives us there. And then in terms of our production now, production deals with the current period. Right. Production deals with the current period. So our production for the first time is given there as 3. It is given there as 3150 right? And then for the next period there, it's given as what? As 2000. It is given there as 2000. So let's have a look now and see how we can go about our calculation. So on 10.2, the actual variable manufacturing cost for BP. Oh, okay, so now we don't need for 2016. Let's go to 10.3. The actual product cost of each BP in 2017 financial year was 750 per unit, and is also made up of the same proportion as the budgeted product cost of each BP. So they are saying we should refer to number 8. Okay, so this is what we have there. And that's what we basically have there. Right, so what we can do, which is what I proposed there on the calculation, is just to ensure that the calculation is the same. Right, just to ensure that the calculation works out on that one. So this is gonna be 150, just to see where it's coming from. 150 plus 75, right? And then plus 112.5 plus 300. Let's see what that gives us. So that gives us 637.5. Let's see how it ends up getting to 750, right? So let's add this plus 112.5. It gets up to 750 when we do that. So, which is what is expected anyway. Right, let me just get to explain this point here. Right, so when they say the actual product cost, right, when they say the actual product cost is 750 per unit and is made up of the same proportions, the same way that it's budgeted here, I suspected that they would most likely make this kind of mistake here, which I explained at the beginning, that this one here, selling and admin cost, is not a product cost. This one is not a product cost. It falls under, it becomes a period cost. This one is not a cost of production. So it should not have been included, as they say it here, that the total cost is 750. So the total cost should be 750 minus 112.50, right? So all this here is accepted as a product cost. So if you are struggling with this, if you just check on the notes, I think one of the notes that I gave, where there is a distinction between the period costs and the product costs. So the product costs are capitalized into the inventory, right? So selling and admin are never capitalized into inventory, so it should not be referred to as a product cost, right? It is a cost, right? It is a cost, but it's not a product cost. But nonetheless, we'll do the right thing of that. So which means the only cost that we need here now is 150, 75, 112.5, and then the fixed overhead, which is 300. So those are the ones that we basically need on that one there. So an easier way of doing that maybe could be taking 750 and deducting 112.50 from that. So that would give you the answer there. All right, let's work it out and see. Right, so these are our costs of production. Right, so let me clear that there. These two, so we know it's 637.5. But we are going to show how. All right, so what did we produce? So according to the question now, we produced 3650, right? We basically produced 3650. So which means we are multiplying 3650 by, which is the total that we got there, right? So which is basically gonna be 750. They say the composition is the same, so we minus the non-manufacturing costs, right? We basically minus the non-manufacturing costs. So that should pretty much give us the production costs there. All right, so if you can punch it with me, this is going to be 3650 times 750 minus 112.5. Right, this is what we get there. Right, then what then would be our closing inventory. But in the same breath. So closing inventory is going to constitute of some of the inventory items that we got from there, or that we manufactured, that we produced during the period, right? So in terms of units, it's 1275 from the question. Then we're multiplying that again using the same cost and 112.5. Okay, that's what we are doing there. So we want this to be a negative here, so we can put it as a negative. So 1275 times 750 minus 112.5. This is what we get there. So the closing inventory there should be the opening inventory there. No? Okay, so we can have it. Now we want it positive there, so I'm gonna put it the same as positive there, right? All right, but we'll also need another closing inventory calculation for period 2. It would also need another closing inventory calculation for period 2, so we can as well. Okay, how did I do this here? Right. All right, no. Right, sorry, and I lost that. Right. Oh, okay. Probably trying to save there. Okay, let's cancel. All right, so because I have this minimized here, I want to be checking the units, right? So if you have your question paper here open, the better. So it's gonna be 900 units. Let me just take you to where I'm fetching these amounts here. So it's that 1275 there, and then it's that 900 on that one. Okay. So we're gonna have that there as 900. We're multiplying, so it's still within the same period. So we're going to use the same costs on that one. So which is gonna be 900 times, right, 750. Then we are deducting the non-manufacturing cost because it's not product cost. So we are deducting that from there. So this is going to be 900. So how you present this, by the way, is entirely up to you. It's entirely up to you. But I want to give you one of the best presentations ever. Right? And then this has to be negative, by the way. Right? So I'm doing this because we normally race against time in an exam. So if I'm able to put this here on the same line, if I'm able to put the calculations on the same line, then you might as well put the calculations on the same line so as to avoid going down and referring to calculations. Just want to make it easier there, right? And then let's see what was produced in the other period. So in the other period, the production was 2000. So let's see what happens with 2000 there, right? This is supposed to close that way, all right? So this is gonna be 2000 units produced, and then we are basically multiplying by pretty much the same thing there because the cost is the same, 7 minus 112.5. So of course, we want to check and ensure all the time before we run up our calculations to make sure that the costs are basically the same. But again, in an exam, you don't have to waste time. Yeah. You don't have to waste time. You only check briefly because it's unlikely that you get something that is a bit off the ordinary. So this is what we have on that now. All right. So what I still need to say, I always tell myself that I'm gonna do this, but I hardly ever check it anyway, is how to deal with over and under recovery. There are two ways in which that can be dealt with. Let's say over and under under recovery. Okay. Over and under recovery. So let's box this here. Right. So in the absence of any over and under recovery, this would basically be our cost of sales then. Right. This would basically be our cost of sales. So we are adding these two amounts, opening and production costs, and then deducting the closing inventory there. So that would give us our cost of sales on that one. So to get gross profit, you would basically, under normal circumstances, deduct your cost of sales from your sales. That will give you your gross profit. But now, because there's a possibility of an under or over recovery, then our calculation of gross profit needs to be slightly adjusted to the over and under recovery. Right, so let's have a look and see, right, based on that. Now let's see. So this is the actual manufacturing and trading results. So this is what actually produced, etc. And then except for the inventories, there are no other inventories. And then the production is given there as that. And then clearly show all calculations in detail. So now we need to worry now about the actual, we need to worry now about the actual overheads. All right, and not Q. Okay, I see a question here. Tando, did you use 3650? Let me see. Okay, maybe I used that 150. Let's check that. Right, 3650. Let's see. All right, I think I used 3650.
Yes, you did.
Am I right on that?
No.
Oh, yes, 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 you are right. It's supposed to be that 150. That's correct. Sorry. Let's make that adjustment there. It's good when people are, when people are quiet, you don't know whether people are there or they're not there. Thank you so much for checking that. Let's adjust that 150. That's more like it now. Right. That's Sibu. Why did you use 3650? Because I was wrong. Yeah? I was supposed to use 3150. You see, once something is bold, now it deceives you a little bit. All right. But I think everything else should be pretty much fine. Yeah? Right. Let's hunt now and see. Let's hunt for what you call these ones. Let's hunt for any indications of the presence of over absorption and under absorption. So let's see now from the question. So the over absorption and under absorption arises when the actual production costs are not the same as the ones that we have absorbed, right? When they are not the same as the ones that we have absorbed. Right? So now we will want to be smart about this here. Let's see if there's anything there. Blah, 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 blah. I don't see anything there. So the normal production capacity is 6,000, right? Let's just see if they mentioned any deviations from that. No? Normal production capacity is 6,000, and then budgeted cost is made up as follows. So that's what we have there on the budgeted cost. And then, like, let's see here, throughout the financial year, the company will absorb its fixed manufacturing proportionally based on the annual capacity, and all over and under recovery are going to be treated as period costs at the end of each of the respective year, not as product costs. Okay, that's good there. So which is essentially what we have done so far. All right. And then this was our production, so there were no inventories. The actual variable overheads for that was given as that, and then for the same period was 290. And then the actual production cost of each PP tire was 750 and is also made up of, so this is where we get that information there. Refer to 8 above. Right, so there's nothing else there. So which means in the absence of anything else that has been said, our assumption now is that if they're saying it's made up of the same proportions as this now, this means the fixed manufacturing overheads are basically going to be the same as the budgeted there. Right. So back to what we were saying now in the beginning, that the budgeted will not necessarily be the same as the ones that are absorbed. So which is why we end up having over and under recoveries. Right. So let's see how we go about that. So sometimes in most questions you'll be given outrightly or explicitly that your actual manufacturing overheads for such and such an amount. So in this instance, we are not given, right? But the hint that we are given now, the hint that we are given on the actual information is the actual cost is 750, right? And it's made up of the same proportion. So which means if it's the same proportion, then which means the total cost for the year is gonna be 300 times our budgeted production for the year, which is gonna be 6,000 there, which is gonna be 6,000. But because the production occurs evenly throughout the year, then which means we need to break it down now, because we are dealing with 2 periods. We'll have to break it down between the 2 periods, where we would have now 3,000 and 3,000 for period 1 and period 2. So let's see how we can work that out. See, sometimes we need to think very fast in an exam. Right, so let's put that and say this is gonna be working number 1. So let's put it on working 1 here. So working 1, right, we are dealing with the over and under recovery. Right, so let's say actual cost. So what were our actual costs? So because production is even throughout the year, so we assume it's 6 months, so it's gonna be 3,000, or maybe rightly it's gonna be 6,000 divided by 2, right, to give us that 3,000. Right, so the production costs are given as what? As 300. So that's what we wanna do there. Right. Let's put that there. Right. Okay, let's do the calculation. So this is gonna be 6,000 divided by 2. Then we are multiplying by 3,000. So this is what we are getting there, 900,000. Right, and then let's say this is actual fixed cost. Let's say costs absorbed. Right. Costs absorbed. Right. So obviously the costs that were absorbed are largely dependent on, we're still what we're using. Also, sorry. Okay, no, this is fine. Since we're dealing with just the fixed cost, it's fine there. Right. So the actual production that took place, instead of 3,000 as we had planned, right, half of 6,000, we actually did 3,150 there. Right. So that's what we actually absorbed in our production. So the absorbed is going to be 3,150 times what? We are only dealing with the fixed cost, right, the fixed cost element. So they are saying it's just the same. So if it's just the same, sometimes the discrepancy could arise as a result of a change in the rate, or as a result of a change in production. So in this instance, it's a change in production. As you can see, it was 3,000 what we, right, in terms of our actual costs, right, we incurred for a capacity of 3,000, but we absorbed 3,150 because we produced slightly more, so of which we expect to have more costs on that one. So this is going to be equal to 3,150. Let's do this again, right? Right. Seems like all my batteries want to run out now. I'm just going to fetch a charger quickly. This is going to be 3,150 times 300 on that one. So we want to find the difference between these two and then decide whether it's over or under. So in the first instance now, on period 1, the actual costs are below the costs that have been absorbed. So what does that mean? It means we over-absorbed. Yeah? It means we over-absorbed there. By how much? By 45,000. So we can do that there. By 45,000. So how do we treat an over-absorption? So an over-absorption basically means that we have got more expenses that we incurred there, more than necessary. Right? So which means the actual costs are 900,000, but we accounted for 945,000. So which means these costs need to be deducted from there. So which means that can basically be, right? So we can either put that as, I think, because this has been put outside of this bracket here, we can simply put it as an addition, right? It's an income. It goes on the credit side. Let me just fetch a charger, sorry, for my laptop. Just give me a second. All right, I'm back. I'm gonna finish this quickly. I don't want to take much of your time. Let me connect this here before it goes off. All right. Just a second. While we connect this machine. All right, that should be it. All right, so this 45,000, so it becomes an over. So let's just say we're going to put our overs there as we're going to put our overs there as positive. So let me put the under recovery as negative there. All right, just for control. Right, now let's look at period number 2. Right, let's look at period number 2. So let's copy this here and then adjust it. Right. So I believe, based on the same logic here, this amount should be the same as that one there. And then let's look at our production in period 2. So our production actually went down now to 2,000. Right. Oops. So instead of 3,150 now, let's have 2,000 there. Right. So this is what we're gonna have right there. Okay. Let me make that clearer. Is it making sense so far? Making sense so far? Are we following each other? Okay, perfect. So this is 2,000 times 300. So that's what we get there. Okay. What we get there. Okay. So we can as well get the difference there. So is this over? Now this becomes under. So how do I know if it's over or under? Right. I really don't have to go to a text to read this or study this beforehand. You just use logic on this one. The same logic that was applied there. So if our actual costs were 900,000, then we only absorbed 600,000. So it's obviously under absorption. Obviously an under absorption there. So we can bring this under absorption rate there. All right. So we want this to be negative here. Sorry. Let's save this amount there as negative, since it's going to be a deduction and another negative there. All right. I think we are done now. The first part of this question. Sorry. So our gross profit now is sales minus our production costs. Sales minus our production cost. So it's gonna be this here minus cost of production, but these costs were over by how much? 45,000. So we want to get that 45,000 there. That's what we get on that one. And then on this one, it's gonna be sales again minus cost of production. And then these ones were under by 300,000. So we end up having that there as our cost. So it is treated as a period cost, but it's not included there. It's not included in the cost. And product cost. All right, and then let's have what now? We're going to have our other costs. What do they normally call them? Yeah, we can simply refer them as other costs. So here, the other costs that we're dealing with are non-manufacturing costs. These are the ones that we are dealing with here. All right, so let's see what we have on the non-manufacturing costs. So for starters, they pretty much said these costs are gonna be the same. Let's see on the actual costs. Let's see on the actual cost. So the actual variable cost for the year, all right, was that, and then the actual product cost was 750, and they're saying it's just the same. So the ones that we have not accounted for are the selling and admin costs. The selling and admin costs. So this is where again we need to watch out. We are tempted to, I would be tempted to take 11250, this one here, and multiply it either by capacity or the selling. But there's a distinction between the fixed and the variable. So let's see how that distinction works. So let's say fixed selling. That's fixed selling costs. All right, so the fixed selling costs are 112.5. Was it times, let's check on top here. I think the fixed were times 60%, right? Times 60%. All right, times 60%. And then we are multiplying, because it's fixed, we are multiplying by the capacity there. All right, let's see. 112.5 times 0.6, 0.6, and then we're multiplying that by 6,000. But then again, because it's half, so let's do 3,000. Let's do times 3,000, and then we apply the same there. So let's just make an adjustment there. We need to divide that by 2. Right. Now we are left with the variables, with the variable cost. Let's see. All right, assuming that these are evenly distributed. So let's say variable selling. Yeah, it's variable selling. So in terms of our variable selling, we say these ones are 112.5 times 40%, right? And then let's look at what we sold. So here we sold 27, I think. Okay, we sold the same, right? We sold the same, it seems. 2375, 2375, 2375. But it would be good to not just assume, to recheck and make sure that what's sold on period 1 is the same as what's sold on period 2. But let's just recheck that to make sure. But I believe we did check that. Let's see. All right. Sales 2375, 2375. So it's the same on both periods. So we work with, in terms of the variable selling costs, we work with what was actually sold. Right. doesn't matter what we produced, but the expense that was incurred on what was actually sold. So we multiply that by 2375, and the amount is the same there, right? So let's make this a negative since it's gonna be a deduction. Let's add up those two. All right, we would so far be done with the first part here. So this would be our net income. Any questions? Any questions? Any questions? All right, so now we are taking this from gross profit, and then we are deducting other costs there, and this is what we get there as our net income. Apparently, we are making a loss on that one. So what I do in most cases, if it's maybe say an assignment, once I see a loss, then I want to just recheck the calculations and make sure that they are okay. But if it's an exam, you just let it go. No? If it's an exam, you just leave it like that. Most likely, you will get marks for principal. You will get principal marks. Any questions? Any questions? Are we all on the same page?
Yes.
All on the same page. Right. That's perfect. Right. That's perfect. So the other costs seem to have been the same. I think what could have contributed to the loss on this one here, right, we had sales. Let's look at how much our closing inventory was. We had less closing inventory there. Less, okay, manufacturing cost there. All right, it was obviously a contribution from the fixed production costs, right, which is here on that recovery there. All right. Nothing wrong on that calculation, right? Seems right. Okay, so we actually absorbed a lot less there because we produced less, 2,000. And that's why the costs are that way. All right, let's move on to the next one now. If we don't have any questions now, we are doing the same thing except that we are using, except that now we are going to be using the direct costing method. Which we are going to be making use of direct costing method. We're going to be making use of the direct costing method. So it's still going to be an income statement. So you can as well take the same. Right, we can as well take the same heading there. Let's bring it down. Bring down the heading actual income statement. But the difference that we're going to have now is on the formats and what's going to be included there. So this is going to be your sales. Then instead of cost of sales, we're instead going to have our total variable costs. Right. Let's have our total variable costs there. Right. And then we're going to decide now what constitutes our variable costs. Right. So we have period 1 and period 2. So I think we can simply maintain the same headings there. Right. So we're just going to finish with that part and then let go of the rest. No? All right. But this is going to need, again, opening inventory. Yeah? This is okay. Let me not fetch them up. Let's actually do the calculation so that we are not confused along the way. Right. Right. Opening inventory, cost of production. All right, and then we're gonna have closing inventory. right? And then, right after we do our calculation here, we can pretty much get what I would call our variable cost of production. And then let's look at other variable costs. Then we can list them here, right? So because we are dealing with marginal costing statements now, or with marginal costing or direct costing, what's going to be included now on our opening inventory is not the full cost, right, as we did here. So here we put in 290 and the 300, right? One was a variable cost and the other was a fixed cost. We don't do that now. We are not doing that now. Now we are only going to be dealing with the variable cost. So let's see, starting with the opening cost, right? Starting with the opening cost, right? Right. Sorry about that. Let's go up. Right. So here we are. Right. So the actual variable manufacturing costs are 300. So this is one that we mentioned. 300. All right. Let me go to my Excel sheet again. I didn't realize that I had not shared Excel sheet that time. Right. There we go. So I was saying, for the absorption, we put both 290 and 300, right? But this time, which one do we need? We only need the one which is variable, so which is 300, right? Which is that 300. So we leave the other one. So it's gonna be 300. Opening inventory is gonna be 300 multiplied by, what are the units? So units, we can simply fetch them here on top. The units are 500 seemingly, so we multiply that by 500. So you can already see the difference between these two methods, that they give different or they basically arrive at different conclusions when it comes to the valuations of our inventories. Right. So one is going to give less than the other. So the one that's giving less is going to be the variable costing one. Right. So the variable costing gives us 300 times 500. Right. 300 times 500. Okay. I don't want these commas there. Right. These cells are the same. Ne? The cells are the same. So we can put them as the same. Right. We're okay with that. Right. Then in terms of cost of production now, in terms of cost of production, so what we did here on this one, we simply deducted the non-manufacturing cost, so which means the amount that we remained with basically included the fixed portion, which is that 300. So one option that you have here, if you want to present this one differently, you can simply come up here and then deal with the, all right, you can simply come up here and then add 75 to 150, and then you also add 112.5. You just add those three there because those are the variable amounts. So you can simply add those ones, and then you multiply it by our production. Then if you like, another method is to take 750, deduct 112.5, and deduct 300, like I'm gonna do, just to maintain consistency there. Right, so we manufactured this, we corrected there, so it's 3150. Right, let's see. So our cost of production, so we are only taking the variable cost of production. So the right way, how did I put this? I said opening inventory, closing inventory. So here it should have been variable cost of production, actually. And then here it's variable cost of sales. Right, let's write the correct wording there. Variable cost of sales. And then here it's variable cost of production. Just for the sake of terminology, né? Just for the sake of terminology. So this is gonna be, right, so let's fetch the figures from the top. So we say it's gonna be 3150, 3150. We're multiplying that by 750, which is the total cost, and then we remove the non-manufacturing cost, and then we remove again the fixed cost there. Right. That's for the first part. And then the second one is gonna be 2000. We're multiplying 2000 by the same, which is gonna be 750 minus 112.5 minus 300. Right. That's what we get on that one. Almost had an overlap on that. Okay, so this is equal to 150 times 750 minus 112.5 minus 300. Right, that's what we get there. And then here it's gonna be 2000 manufactured less there, right? 2000 times 750. Okay, we need that in brackets there. 750 minus 112.5 minus 300. Okay, and we have that there. Okay, and then the closing inventory here is gonna be our opening inventory there. Excuse me. Oh, right, we are finishing up. All right, so what then would be our closing inventory? So the calculation is the same, except that we are only including the variable elements, right? So it's just gonna be 1275. So let's do this. 1275 times, so it's gonna be the same as what we did there on top. It's gonna be 750. 750 minus 112.5 minus 300. Right. Okay, that's for the first one. Let's do second one. Okay, there's supposed to be a bracket somewhere there. Let's put that bracket there to indicate how we need to work this out. Right, and then what was closing inventory for the other one? Let's see. Closing inventory was 900, so take that 900 and we're multiplying the 900 by 750 minus 112.5 minus 300. Right, let's close the bracket. Okay. We want that to be negative, yeah? We want that to be negative, so this is gonna be minus 1275 times 750 minus 112.5 minus 300. Right. We have that there, and then we also want this one to be negative. It's a deduction, it's less closing inventory. So it's gonna be 900 times 750 minus 112.5 minus 300. Right, this is what we have there. Right, let's work this out. So this is opening inventory plus production, and then minus closing inventory. That will give us the variable cost of sales there. And then this here, the closing inventory is gonna be opening inventory there, but it has to be positive. So let's put it there. So what we applied on the first period, we do the same on the second period. Okay. Now we want to see if we have other variable costs, of which we already know that we have the selling and distribution costs. So let's say selling and distribution. So these ones we already calculated previously. It's the same calculation because they are based on the sales, right? They're basically based on the sales. So we're gonna have that there, and then we pull these. Right. Let's put this in a big box. Right. So I believe we don't have any other variable costs. Yeah. All right, so this is gonna be the variable manufacturing costs, right? Which are these ones here, which are the variable cost of sales, which have been adjusted obviously for inventories. And then we need to add the other variable costs that we have. Then we have our total variable costs, those two. Right. But we want it negative, by the way. Let me make an adjustment there so that we are consistent. So even if you make it positive, when you are calculating, just make sure to understand that it's a cost and it needs to be deducted. Yeah? You just need to understand that. So I'm making it negative here so that we are not confused since it's a class. Okay, so this is total contribution. Let's put this as total contribution. So total contribution is going to be sales and then minus our total variable costs. This is going to give us our total contribution. Right. Then we need fixed costs now, because you realize that we included every cost here except for the fixed costs. What fixed costs? We want the actual fixed costs, né? Right. So which is actual production fixed costs. So remember these ones we dealt with, né? What are they? These ones here, this 900,000. It's the actual production cost, 900,000. So we have that 900,000 there. Oops, my phone is falling. Right. I'll be done in a minute or two. All right. Then what other fixed costs do we have? I believe we have this selling and admin, fixed selling and admin. Right. The calculation is the same. Fixed costs don't change. Right. Let's take them from the top there. Right. Which ones are they now? I can't remember. Fixed selling. Okay. So they must have been. Oh, okay. These ones. I see. Yeah. Fixed selling. Then this is what we have there. Right. All right. So let's total these up. All right, so we want the sum of what's inside there. There you go. Right. Just guard against getting a mind block. Eh? All right, and this is going to be our net profit. So the next question basically wanted us to reconcile between the two profits, né? Of which we'll briefly start on that. All right, so I'm going to make this positive now. Né? I'm going to make these amounts positive. Right. Sorry, negative. I want them negative. So this is what we have. This is what we have there. Right. So we are simply required to reconcile between those two on the next session. So any questions before we call it a day? Any questions? Any questions? Any questions? Any questions? Right. So the one thing that you need to guard against, again, I'm gonna mention this one. The other reason why we fail in examinations, right, is, or okay, part of the thing that contributes to people getting mind blocks or whatever you call it, mind jams in exams, it's because of fear, and I already said that. It's because of fear, because of your mental attitude when you're going to the exam. And the biggest cause of your fear is obviously your fear of failure, which is your fear of making a mistake. So once you get into an exam and you're scared of failing, you're scared that you're not going to pass, then you are most likely going to fail the exam. It's because you're going to be panicking, right, with every question you tackle the question wrong. Once you see that maybe there's something that you've done wrong, then you start panicking. It completely throws you off the track. You see, so that shouldn't be the case with you. All right.